Good afternoon, and welcome to Noble's Pond Virtual Series. It is now 2 o'clock, and we are going to give our attendees just a moment or two to continue to log in, so we will begin our program momentarily. Again, everyone, thank you so much for joining us today for Noble's Pond Virtual Series. We still have a few attendees who are logging in to the GoToWebinar platform, so we will begin our presentation momentarily. Well, good afternoon, everyone. Welcome to Noble's Pond's program, Financial Game Planning 101, a virtual money mini camp. We want to thank you all for joining us today for this part of our Noble's Pond virtual series. My name is Beth Haynes, and I am the Director of Marketing for Noble's Pond, which is a 55+ active lifestyle community located in Dover, Delaware. Before we begin, just a few housekeeping notes. All participants' microphones have been muted for the duration of our program, and we do encourage your questions, which you can submit through the panel that you can see here on the left graphic that says questions. We have a lot of content to cover today, so we will be addressing all questions at the end of our session. So as you have questions, please submit them. After the end of our presentation, we will address as many questions as possible. If we don't have time to answer all of the questions, you will be receiving a follow-up email with any specific insights that you requested. We're also recording today's presentation, and we'll be providing it to you along with contact information and a follow-up email. Now, before we begin, let's try testing out that question panel. If you can hear me, please type yes in your question panel so we can make sure you can hear us okay. I see a few yeses coming in. Excellent. Great. Thank you all so much. And again, we definitely encourage your questions for our panelists today. So please feel free to submit as they come to mind, and we will address all at the end of our session. Today, I'm joined by two members of Key Advisors Group, LLC, an independent financial advisory company that focuses on providing customized retirement planning strategies designed to work towards meeting each client's specific goals. Key Advisors has offices located within Dover and Lewis, and they're a trusted advisor for many of the current Noble's Pond homeowners. Doug Ferris, one of our speakers today, has been successful in the financial services industry for 29 years and co-founded Key Advisors Group 20 years ago with his business partner, Eddie Gabor. Doug is a resident of Wyoming, Delaware, where he resides with his wife, Elaine. His successes go way beyond the business world, and he attributes his proudest accomplishments to his family, his 4 children and 6 grandchildren. Doug is also an active member of the local community and has been for many years. He's the founder and coach of the Dover CR Raiders POP football program, a board member of the Dover Boys and Girls Club, co-founder of the Master Networking Group in Dover, and chairman of the Ferris Family Charity. Doug enjoys spreading the knowledge he has earned over the many years in business with his colleagues, friends, and clients. Welcome, Doug. We also have Mike Redmond joining us today. As a financial advisor in the Dover office for Key Advisors Group, Michael specializes in retirement and estate planning strategies, as well as money management, working with his clients to address their financial and retirement planning needs to help them meet their goals. He's a licensed advisor in several states, including Delaware, Maryland, Pennsylvania, New Jersey, and Virginia, just to name a few. And he too resides in Delaware with his wife and his 2 kids. And welcome to you, Mike. Before we begin with our program, we want to learn a little bit more about those who are joining us today. So we're going to do a poll. And the question is, where do you currently live? So using your panel, if you can share where you live. Do you live in Delaware, New York, New Jersey, Pennsylvania, or other? And if you live in a different state that we didn't note specifically, if you could type within the question box, we would appreciate it. So where do you currently live? Doug and Mike, it looks like we have about 43% of those who are joining us who actually live in other states, including Virginia, Massachusetts, just to name a few. 36% of those of us who are joining today hail from New Jersey presently, followed by 14% from New York and 7% from Pennsylvania. Oh, and I see Susan from Long Island, New York. Welcome, welcome to everyone, and thank you for taking this poll. We're going to go ahead and close that. And now to start sharing the financial halftime report, I'm going to be turning it over to Doug. So Doug, take it away.
Well, thank you very much. Beth, I think you have a future in entertainment for sure. But I appreciate the information you passed on. I don't have to give a whole lot of information about who we are personally. Just a little bit more about Key Advisors, which is very, very important. Both Michael and myself are fiduciaries, which is extremely important. And we enjoy having the independence to do for our clients what we feel would be in the client's best interest, not necessarily a particular company itself. So what you're about to see today, and just I'd like to preface it with this, is the halftime report. It's a presentation that we do each and every year for any amount of our 1,200 clients. We do it every year in the month of August. Obviously, this has been a much different year, as we can all imagine, and we're unable to meet with our clients during that period of time. So we decided to put this on hold. So we are not only inviting our clients to do this in the next couple of weeks, but of course those at our Nobles Pond community, and of course those of you folks that are out of state as well. So with that said, let me just go ahead and we will begin that presentation at this point. It won't move. Beth? My screen is not moving. I'm sorry. And I know we just ran through a test.
Everyone bear with us 1 second.
That's how you got it off of there last time.
I know. I'm not worried about that. I'm worried about you moving your screen.
Yeah, our screen is not moving, Beth.
Okay, give me 1 second. Everyone bear with us. I'm going to switch presenters again.
I don't think she switched.
She did, because I can see it.
Yeah. Now it's different. It says 100%. Looks like we're in good shape, Beth.
We can see your screen.
Okay, fantastic. Okay, well, as Beth already instructed you, obviously we're not interested in having any cell phones involved either as well, too. Beth also spoke a little bit about questions. We will certainly get back to you folks with, and I'm sure there's a great deal of questions in lieu of, where we are right now with the stock market, the election, and many other things that are going on with COVID as well, too. So, with that said, let's go ahead and get started with the actual presentation. I do have a disclaimer up here for the lawyers. They just want to make sure that we are disclaiming exactly who we are and what we do for a living. And if anybody needs to reach us or who our broker dealer is, they can reach them as well too. So again, if there are any questions as the presentation goes on, please feel free with that as well too. So really what we're going to be doing today is that we're going to have an opportunity to review really what the first half of the U.S. markets have brought to us. We're going to take a little bit of a closer look at the fundamentals that support the economy. And of course, the second half outlook on what we would look at moving forward. And of course, Michael will be covering that for us here as well too. So let's begin with this. Let's review the first half of the U.S. markets for 2020 of this year. As you can imagine, you can see what the first half really looked like, what a different world we lived in 2020. Really, at this point, these fundamentals are extremely important, and this gives you a very good idea of really what went on during that period of time. So if you take a look at the snapshot of the S&P performance for the first 6 months, the S&P really is a tracking of market capitalization of the top 500 largest domestic companies in the United States. The index is often used as a comparison to use a benchmark to see exactly how your asset is performing compared to the S&P 500. So at the end of 2019, which was a very good year, the S&P ended at approximately 3231. At the end of June 20, you can see the S&P closed at 3,075, obviously down for the year. Everything at that point in time to do with the COVID environment as well too. But let's take a look at really how it actually affected each particular scenario that went on during those times. So you can see in January and February, the market continued its roll right from 2019, and we were quite excited about that at that point. On February the 25th, their health officials started to warn us of a significant disruption due to the COVID-19 virus, and things just simply happened from there. President Trump instituted a ban on Europe. That was on March the 12th as well too. President Trump also says that the COVID-19 could certainly extend into August. Now, we could probably laugh at that at this point, but we had no idea how long that would last. And if you look at where the graph is right there, we can tell you that the bottom of the market was March the 23rd of 2020. As you can see, things started to get a little bit better. April the 21st, we had some positive results from the clinical trial for COVID-19. And on May the 18th, the Fed reinstates its commitment to support an economic recovery. That was a big deal back then. They basically told us they will do anything it takes to keep the economy afloat, and that was huge. Unfortunately, on June the 10th, the market dropped 1,800 points on fears that COVID cases were rising dramatically. So you can imagine the difference from December of 2019 to where we ended up at the end of June of 2020 as well too. So quite significant under those circumstances as well. So the next screen tells us this. Each and every year, they go out and they find the media, find supposedly the best minds in the business, and they like to look for targets on what the S&P 500 will do for the year. So as you can see, these were the predictions. These were the targets. It looks like Morgan Stanley and UBS were the only folks that were negative on the market for 2020. Everybody felt the market would be higher in 2020 than it was in 2019, and we can all see where we ended up at this point. All right. So now let's take a look at some of the economic and financial indicators that really can help you understand exactly how we got here. So what drove the U.S. equity market? So taking a look at the performance, we like to use these what we call speedometers, which are really just nothing more. It's a sample of an economic and a financial indicator. So if you take a look at these indicators right here, this was January of 2010. We were on a recovery from the recession at that time, although a very slow recovery. But obviously, if you look at the colors, green would be positive, yellow would be neutral, and of course, red would be negative. At that point, we didn't have any negative. We really only had three that were neutral, and everything else was really moving in the right direction. So with that said, let's do a comparison to see what January of 2020 looked like as well too. But as you can see, the indicators have changed significantly. We have a lot more caution, which would be the amber. We are still significantly in the green as well too. And then we have two negatives, which would be the political environment and geopolitical risk, which both of those indicators, I can tell you, I'm sure are not a huge surprise to anybody. But by that time, then we made it to June. So by June of 2020, we can see what the indicators are showing us. We only have 4 that were in the green. We have 9 that were in the yellow. And of course, 7 were in the red. At this point in time, there were states closing businesses, closing schools. There was a lot of uncertainty out there as well too. And unfortunately, all the states were not working together because every state is a little bit different and regions are a little bit different as well too. But there was definitely some mixed signals going on in June of 2020 as well. So these financial indicators are not absolute certainties, but it gives us the directions on where we would like to go and where we would like to move as far as indicating what investment trends we'd like to use. We're also looking at possibly what sectors of the market that we'd like to use as well too. So at this point, things were very bad, probably hadn't been that bad since the credit troubles that we did have in 2008 as well. So let's take a look at really what the COVID-19 pandemic did. I mean, historically, the Fed's intervention here really helped us with some financial stimulus. So let's go ahead and measure exactly what they did, and we'll get down to really the nitty-gritty of exactly how they did help us as well too. So if you take a look at the dates here, on March the 15th, the Fed cut the rate to the banks basically to 0, which allows the banks to loan the consumer dollars at a much lower level of rate of return. Also, that's why our mortgage rates are so low right now, and it has a nice impact, definitely a very good impact on the economy. They also had QE, which is quantitative easement of at least $700 billion in asset purchases as well. March the 17th, they created what they call the Commercial Paper Funding Facility as well. The Fed was getting ahead of this the entire time, and I do want to commend them really because they did try to catch the bottom in order not to make it go down any further, and also maybe not to create any panic within the community as well. If you look at March the 23rd, which coincidentally happened to be the bottom of the market, they established what they called the funding to support credit for large businesses and liquidity for outstanding bonds that they were purchasing as well too. On April the 6th, they created the lending facility to buy what I'm sure you're all familiar with, the PPP loans right now, which really was out there to help Main Street businesses and of course municipalities as well too. And then on June the 8th, the Fed expanded its Main Street lending as well too. So they did throw in more money in there in order to facilitate these assets as fast as they can. And there's no doubt there's many businesses that have been hurt by this pandemic, some companies and businesses that will never return. But I want to say that the Fed did get a pretty good handle on that, and they stopped it as much as they possibly can from moving any farther forward. At this point, let's take a look at some of the charts that we'd like to show you. This first chart is going to talk a little bit about what we call corporate earnings. Corporate earnings, as you can see, the two lines generally move in the same direction over the last 10 years, really over the last decade. But what really happened in the last few months, take a look at it. The volatility in the stock prices and earnings is the result of COVID-19. So here are a couple of reminders, or at least one reminder you have to remember. Past performance does not guarantee the future. So over the next 10 years, the correlation between stock prices and corporate corporate profits really may not look the same. They may actually look different. But if you take a look at the correlation between those lines until COVID hit, you could see that obviously COVID had a huge impact on corporate earnings as well. And these are some of the places that we look in order to make decisions on where we want to place our clients' assets. Because we're always trying to find trends, whether it be the sector of the market or the type of market we're looking at as well too. And sometimes you look at it too late. We're trying to catch the beginnings of those in order to try to maximize the return for our clients as well too. Taking a look at this next chart, which is what we refer to as the CPI and the core CPI, the Consumer Price Index. Really, this is an inflationary guard. At the highest level, the Federal Reserve has three functions, really. One is to provide an effective payment system for the United States government. The other one is to regulate banking operations, and of course, also to conduct monetary policy. Now, when conducting monetary policy, the Fed is taking on the task with supporting the maximum employment, stabilizing prices, and moderating long-term interest rates, which are huge, by the way. That's really what keeps the economy moving as well. Now, as it works to uphold the monetary policy goal, one of the indicators the Fed monitors is the overall what they call consumer prices, or CPI, which helps determine whether to adjust interest rates or not. This lets them know, are we in an inflationary area, are we in a deflationary, or are we flat? So inflation, as far as the Fed is concerned, their target is 3%. The Fed is very comfortable with a 3% target, and that's really what they run their CPI off of. And again, over the past 50 years, you can see exactly how that worked as well too. So the chart, if you take a look at it over the past 50 years, the CPI tracks what urban consumers pay for specific groups of goods. Now, what it does not include is energy and food. And one of the main reasons for that is those price swings on energy and food can be very, very volatile. So it's very difficult for them to include that as well too. But at this point in time, we feel, and obviously the Fed feels, that inflation is under control. If we take a look at the next screen with unemployment and wages, this chart shows that unemployment rate over year and wage growth for the past 50 years. Now, do you notice anything that is familiar between these two lines? And I'm sure you've seen this. Most of the time, wages and unemployment have what we refer to as an inverse relationship with one another. When one goes up, the other one goes down. But my goodness, whoever could have predicted the change in the recent months due to COVID-19? And as you can see the chart, unemployment jumped to 14.7% in the month of April. Then it did fall to 13% in the month of May, which was very surprising to most Wall Street analysts. As a matter of fact, currently, we are actually under 10% at this point, which is a very, very big surprise. And I know Michael is going to talk a little bit more about that based on current circumstances and some of the things that we were trying to do to really hedge for these issues as well. So where do we go for the rest of 2020? Well, many Wall Streeters really, and some of the brightest minds really are trying to figure that out as well too. But you can expect an unemployment rate will be in line with the outlook of COVID-19. And unfortunately, the COVID virus will dictate has a lot to do with our unemployment rate, which is going to be very, very difficult to control at that point. Now, at this point in time, I want to pass this on to just a very talented gentleman. He's one of our senior investment advisors. Michael's going to take over from here, and he's going to start talking about the consumer sentiment, which is an index that we follow as well. Michael?
All righty. Thank you, Doc. Beth, I think you're gonna share my screen. And there we go. So we see the slide for the index of consumer sentiment, correct?
We do. You're good.
Okay, perfect. Well, Beth, thank you for inviting us to this. This is a great chance for us to share some of the knowledge that we have acquired over the years from the experts that we deal with. And also at the end, I'll spend a little bit of time, because we do have current clients on this webinar, and share some of the changes that we made to their portfolios. And also, since this is a little bit of an outdated report that we're doing, I'll share what our thoughts are moving forward for the rest of this year and kind of what we think about moving into 2021. The Consumer Sentiment Index is a very important index. It was established by the University of Michigan, and it's one of the most widely used sources to help analysts understand how the actual consumer feels about the economy. And as you can imagine, that's pretty important to know when you're looking at making investments. If you are a CEO of a company, you want to know what the consumers are thinking, because obviously whatever you produce, you're hoping that they're going to have to purchase at some point. What it does is it surveys at least 500 residents of the continental US each month by phone. Now, I don't know anybody that's gotten that phone call, but I assume that they do this on a pretty regular basis, because we're certainly seeing the data. The survey uncovers consumers' opinions regarding their finances as well as business conditions in the country. Understanding how people feel and the economy is essential, because consumer spending accounts for more than 2/3 of the gross domestic product. That's very important. I mean, we as consumers, we're always buying things that are hopefully produced here in the United States or produced worldwide. What our thoughts are about the economy moving forward is going to control what we do. If we don't feel comfortable about our jobs, if we feel the economy's on shaky ground, then we're less likely to go out and buy that new car or buy the new pocketbook or spend a little extra on a vacation. So this is a very important economic indicator. So the chart shows a long-term uptrend in consumer sentiment. So for a long time, at least since 2010, consumer sentiment has become very, very positive. Now, the obvious happened in March of this year, and consumer sentiment really took a nosedive, primarily because people didn't know what to think. And I honestly don't know if anybody knows what to think at this point, because we're just not sure about the information that we're getting. But we are aware that the COVID-19 pandemic is real. It is happening, and it's certainly had a negative impact on the economy, on people's health, and moving forward is the biggest question mark. So we have, since this is dated the end of June, since the end of June, the consumer sentiment actually has spiked. I looked it up just the other day to see how much things have changed, and we've had a very nice spike since we've had this recovery. Currently, you know, some folks say, well, it's got to go up because people feel it can't get any worse than it did in March. And I guess that is one way of looking at it. But the other situation is regarding consumer sentiment is the government and everybody else is in a tough situation. Do they open the economy early and risk more of an uptick in the virus, or they keep everything closed and then severely damage the economy. We can argue all day back and forth about this. I'm very happy that I'm not one of the ones that has to make that decision. But all we can do is just wait and see, put our 2 cents in when we can. As financial advisors, Doug and I don't weigh in on political situations. We're more of a sit back, make a plan, make sure we have a lot of variables to that plan so that we can be very proactive rather than reactive, and make sure that our clients' accounts and portfolios are set up in a way that they feel comfortable can stomach any changes that might come with the market. The next slide. I think I'm, oh, there we go. Sorry. The next slide refers to existing home sales. So when we take a look at existing home sales, again, this shows as of the end of May. If we could extrapolate this out, we would see that existing home sales are definitely on the rise. I don't know where everybody lives. I know Beth was nice enough to give us a little bit of a detail of who all is logged in, but here in Delaware, homes are selling faster than we've ever seen before. It's almost like it's 2005, 2006 again. We drive down to the beach. They're building developments just as fast as they can get the lumber. We've had probably 10 or 12 clients sell their homes this year, and a handful of them sold them inside of 24 hours for more than they were actually asking. And statistics like that are things that we haven't seen in many, many years. I think it's more of a positive than it was back then. If you talk to anybody that's went out to get a loan, they always complain about all the information that is needed, what the banks are requesting. And to be quite honest, if I'm a bank and I'm loaning somebody hundreds of thousands of dollars to buy a house, I think it should be a little difficult to get that loan, because we definitely don't want a repeat of what happened in 2009 regarding the loans that were people weren't able to pay their mortgages. They should have never gotten approved for loans that they got. So we feel pretty good about this housing situation that we see. One of the questions or quizzes we wanted to give you is, would you believe that how existing home sales would be a leading indicator of the economy or a lagging indicator? A leading economic indicator are statistics that tend to precede overall economic trends. Building permits, for example, that's a leading indicator because of home construction. So if there's a lot of building permits being submitted, then we know that home construction is going to begin, which can be a nice positive for the economy. Lagging indicators are statistics that tend to follow after a particular economic trend. So with that being said, believe it or not, existing home sales is a lagging economic indicator. So even though we've seen a drop from February to May and we've seen a nice increase, we feel that this is a great setup for 2021 and moving forward. Interest rates are at all-time low. Unfortunately, lumber is in a short supply, so we've seen a very large increase in the home price, the home resale price. We've actually seen a slight stall with the most recent numbers that have come out, primarily because a lot of houses have almost priced themselves out of a situation where people can afford them, or with what people are willing to buy. We've also run into a lot of folks that have decided to sell their house, but unfortunately the people who were potential buyers were not able to get a loan based on the sale price. So they either had to reduce the price of their house, or the potential buyer had to come up with more money. And the main reason is there's just not comparable comps, because existing home sales have risen so quickly in such a crazy environment that we're in. The next chart that we have here is debt payments and percentage of income. I think this is a very, very important chart. What it does is it gives us some perspective on how much revolving debt, example is like credit cards, that households manage. You know, as financial advisors, this is one of the major things that we try to focus on when we bring a prospect in or any new client. We're not big fans of having this type of debt. Now, if you have credit card debt and you pay it off each month in order to get whatever perks or rewards or anything that they offer, that's great. Take advantage of it. But the key is to pay this off. And as we can see here, it means that Americans are using debt more wisely. We're not sure if that's what they're doing, but we know that it's at an all-time low compared to the actual personal income. So this means people in their households are having a lot less revolving debt, credit card debt we call bad debt, and hopefully that they're saving a lot more. It's often, for a long time, been, I think, an international joke that Americans don't know how to save money. Whenever you run into somebody from Italy or somebody from China or one of the Asian countries, they tend to they're very focused on what they save. Unfortunately, in America, especially with my generation, I've seen a lot of buy now, pay later, and it's kind of just, kick the can down the road and worry about it later. What this data is showing us is that we're seeing a definite change in that trend. So Americans don't want to go through what they went through in 08 and 09, where we saw so many bankruptcies. So they're getting rid of that bad debt, and they tend to be saving a lot more than they used to. The next slide talks a little bit about potential headlines. One of them is, as you can see here, the COVID-19 treatment being approved, possibility in 2021. COVID-19 vaccine advance, an American elects a president. And here we are, November 3rd, or I think today's the 3rd, the day after the election, and we still don't know. And we probably won't know for a while. The market's remarkable resilience in the first half of this year can be attributed to unprecedented monetary and fiscal support, as well as a lot of optimism regarding a potential COVID-19 vaccine. If you follow the markets as close as we do, you would see on days where Moderna or Pfizer or Merck or Regeneron came out with positive tests or results that were unexpected in a positive way, the market just skyrocketed. But if one of those tests failed or if there was an issue, then we saw the market go down. You could almost time the market based on that. While the Fed has promised to continue supporting the economic recovery, it remains less than certain that the Fed can maintain its pace of spending or that medical professionals will discover a vaccine at any point in time. When we look at the presidential election, at Key Advisors, we tend to take a contrarian view of everything, and it's kind of panned out for us over the 20-some years that we've been doing this. What we look at is if the herd is saying that the market's going to do something because of a certain situation, 9 times out of 10, if everybody believes it'll happen, it doesn't happen. It tends to go the exact opposite way. And what I mean by that is heading into the election, everybody agreed that there was going to be a lot of volatility around the election. We thought there would be a contested election, which still possibly could happen. The volatility hasn't really happened around the election. Last week, we had a few down days. Here, the last couple of days, we've had an unbelievable up day today and yesterday. So a lot of the conventional wisdom and the conventional way of thinking doesn't seem to be panning out. What a lot of the experts that we read and take a look at have indicated to us is that no matter who wins, they have delayed the stimulus package, and whoever wins is going to get this stimulus package passed. And that will undoubtedly be a positive for the economy. So as much emphasis is put on this presidential election, for right now, no matter which one wins, believe it or not, we feel that there is still going to be a positive outcome in 2021. And I will go into just a little bit more detail near the end about that. Now what we want to take a look at is a second half outlook, which is funny because this was done in May and it was projections about what these economists would think would happen the rest of the year. So now we can take a look and see how correct they were and where they were just a little bit off. So if you take a look at the first chart, what it shows is the change in real GDP. Much like some of the previous charts, the COVID-19 is having a rather dramatic effect. And this one real gross domestic product is expected to drop anywhere from 4 to 10% this year, which is unprecedented levels. The Federal Reserve's chart also shows a dramatic rebound in 2021 and 2022. And that goes into some of the thinking that we feel, and also it plays a role into how we're positioning our current clients' portfolios. As you can see in a longer term, which is showing up right in this area, they feel it's going to average around 2%. So for the second quarter of this year, real GDP fell over 31%, which has never happened before. In the third quarter, surprisingly, I got to admit to us as well, to everybody else, the GDP bounced back 33.1%. That's the fastest ever recovery in the history of the entire nation. So, when you think you have it figured out, the market flips things around and you get surprised. That's why we're totally against trying to time the market. We're more in line with let's build a portfolio that everybody can stomach. But there are certain situations that we feel like where we need to intervene and become a little more proactive and make some changes along the way. So just so everybody understands, GDP, or gross domestic product, is the value of all goods and services produced in a year, and it's adjusted for inflation. So you can see the first line here for 2020, they feel there's going to be we're going to have negative GDP, but we've also had an unbelievable bounce back, which leads into a possible better 2021 scenario. So we're really looking forward to seeing how exactly this is going to play out. The next chart we're taking a look at here is corporate profits. And I mean, this is almost like all the other charts we see. You can see the effects of COVID-19. Yeah, in January of 2020, the corporate profits were very, very high. Then we had this steep drop in the second quarter of this year. Now, even though we've had this huge drop in profits, companies have paused on guidance. They're not giving future guidance. They don't know what to expect. We've still seen the stock market hit all-time highs over and over again. So this speaks volumes about what we talked about earlier regarding consumer sentiment and their outlook on the economy. So what it also means is that the stock market trades 12 to 18 months out in advance. So they're not looking at these short-term moves that we're seeing. Everybody knows because of what happened in March and April and in May that corporate profits are going to be down. Nobody was going to work. Nobody was going out purchasing things. It was a perfect storm of bad situations. But even though they see that, they feel that there will be light at the end of the tunnel. There will be a vaccine at some point. We have the Fed propping things up, and we have some other scenarios that we're going to discuss that can explain why the stock market has such an increase, a sharp increase, that a lot of folks really were unexpected. The next slide, the professionals that put this together wanted to stick this in because everybody needs to realize right now that even though you have bonds or some sort of fixed income, bonds are not guarantees. You can have a bond and they can lose value. So right now, as far as fixed income goes with a lot of our clients, we are big fans of laddered bond portfolios up until about 6 or 7 months ago. When the 10-year went as low as 0.5, 0.6, it became very unattractive to put anybody in any sort of laddered bond portfolio. So what we have transitioned to is a fixed income manager, which gives them better flexibility. Right now, I can tell you that this fixed income manager is using a lot of mortgage-backed securities, which if you remember from 08 and 09, that's almost like using profanity. That was a bad word at that time. But what's happened is the Fed has stepped in and basically backed up these mortgage-backed securities. So by no means are they FDIC insured, but when you have the Fed backstopping everything that's out there regarding corporate bonds and these securities, there's not a lot of risk at buying these types of investments. So that has been a big reason that we have seen the yields stay down. And the way you can lose money in a bond, especially a bond mutual fund, is if you buy a bond today, a $10,000 bond paying 2%, and let's say it's a 10-year bond, and 4 years from now, you can spend that same $10,000 and get a bond that pays 3.5%. Well, if I have $10,000, am I going to buy your bond that only pays 2%, or am I going to go ahead and put money in and buy a bond that pays 3.5%? Well, obviously, I'm going to buy the new bond. I'm willing to purchase your old bond that pays 2%, but I might only give you $8,000 for it. So now your bond is worth less than it was when you purchased it. Now, the benefit of having a corporate bond or an individual bond itself, as opposed to a bond mutual fund, is that as long as you hold that bond for its tenure, meaning in this situation 10 years, and as long as it stays around and pays the interest that it's supposed to pay, at the end of 10 years, you will get your money back. So that is a positive for owning individual corporate bonds. But when you look at a bond mutual fund, there's always people redeeming their money in those funds. So bond managers are always having to sell bonds at inopportune times, and this causes even bond funds to lose value. So that's, again, why we use a specific fixed income manager, which is not a mutual fund. It's a manager that actually owns these securities. And we use ETFs as well, because they give just a little bit more transparency. And even though they act as similar to a mutual fund where everything is maturing, there's always new money maturing, which allows them to buy newer bonds at better rates. So there's a couple strategies that we like to use outside of ladder bonds at this point. But being an independent advisor, pretty much the sky's the limit within reason. So we are able to transition our clients' portfolios from different underlying investments when the economic situation determines or dictates what we need to do. That's the benefit, again, of being in a very liquid portfolio that you can move around, or your advisor can move around for you. The next slide talks about just staying focused on the fundamentals. This is so important. It's so important not to get caught up in any of this short-term noise that we're hearing. I know it's hard when it's shoved down our throats every day through the media, through social media, through the newspapers, if anybody still reads them, or anything, but it's so important to make sure that whatever portfolio you have, you do revisit on a regular basis. For those of you that are on the call with us, you realize that you hear from our office on a quarterly basis. Doug and I were in here working 10-hour days in March because we reached out to a very high percentage of our clients to just let them know that we are here, that we're exploring some options as far as making changes to their portfolio, but we wanted them to know that we are on the situation, and if they had any questions, they can definitely reach back out to us. But it's so important to remember why you're in a portfolio and what that portfolio is designed to do for you. This is one of my favorite charts that Doug and I have used for many, many years. I love getting this halftime report because then it gives us a better update. What this chart is showing is the blue bars represent the final return of the S&P 500. The little red dots represent the lowest that it was for any given year. So obviously I'm going to jump to the one that's the most obvious, and that's the negative 38%. I think we all can take a wild guess that that was 2008. The market fell 38%. At one point in time in 2008, it was down 49%. That's what this is showing. Now, for those of you who stayed the course, who held on, we know that the next year the market made 23%. But for those of you that were with us over that time, that was not an easy ride. Looking back, it seems like common sense. But remember, the following year, we were down another 28% at that point in time. But we stayed the course, held on to your portfolio, and you bounced back to 23%. So what this is essentially saying is that any given time, even on the best years, there's points in time where the market is usually down double digits. So it's very important that you and your advisor, or if you do it yourself, that's great, that you construct a portfolio that is fluid, that is liquid, and that you feel comfortable in up markets and down markets. It's easy in 2019 when the market's going straight up. If I'm being brutally honest, we had our quarterly reviews. There wasn't a whole lot of people that came in 2019. Mainly because the market did nothing but go up. So they said, hey, it's working, I'm happy, go for it. Little different story this year. Everybody wants to come in. Unfortunately, we in the beginning, we weren't able to see folks, so we were doing Zoom calls, we were doing conference calls, and that's just something that Doug and I do not like to do because we enjoy our face-to-face meetings with our clients, but we're gonna adapt just like everybody else is because of what the pandemic's throwing at us. But it is so important that you revisit how your portfolio is constructed. Now, with the next slide, what we're taking a look at here is the returns of the S&P 500. I found this pretty interesting. This slide shows why it's important to ignore the headlines, especially the short-term noise, and focus on your time horizon, your risk tolerance, and your goals. And for those of you that are on the call that are current clients, if you remember back to that very first appointment that we had, Doug and I, depending on who you met with or if you met with both of us, we didn't talk anything about your current investments, barely even looked at them on that first appointment. We spent over an hour talking about what are your goals, what's your time horizon, what's your risk tolerance, what's your objectives for this money. And not just overall, do you have certain pots of money that you want to save up to buy that beach house that you've always wanted? Do you want to buy that classic car that you've always wanted? It's important to separate your money. I know my grandmother used to use envelopes, Christmas envelopes, birthday envelopes, golly day. There was an envelope for everything. That was the old way of doing it. And we're definitely proponents of that. We call it buckets of money. We just don't agree with keeping it in your desk drawer anymore. I think there's better places we can all agree to position that money. But what this chart is showing is, if you look at the beginning of 2000 to the end of 2019, that's 19 years. We can see the danger of missing some of the most powerful daily jumps. The chart illustrates a $10,000 investment, January 3rd of 2000. If you invested $10,000 then, you would have more than tripled in value to over $32,000 by the end of 2019 if you stayed invested. Now, what the next bar shows is that if you missed just 10, and I did the calculation, so over 19 years, you have 6,935 days. If you miss 10 of the best days, your average return goes from 6% to 2.4% for 10 days out of 6,900. If you miss the 20 best days, you're basically even. And if you miss the 30 best days of the stock market over that time period, you've lost money. So 30 days out of 6,935, you missed out. So this is the importance of, one, trying not to time the market because it just doesn't work. All of your friends that say that they're able to do it, they're like gamblers. They only tell you about the times they win, not all the lose times they lost. And it's important to build a portfolio that when the market goes down, because it will go down, it's the only two guarantees that we give at Key Advisors. The market will go up and the market will go down. I can guarantee you that. But it's important to understand that where your portfolio is and how you're positioned, that you're going to be comfortable when the market does go down. A majority of our clients are either retired or getting ready to retire, so we kind of lean on the conservative side when it comes to investing clients' assets. We've been lucky enough to surround ourselves with clients over the years that have positioned themselves the correct way. They did all the hard work. They retired with very little debt. They saved a lot of money. They live well within their means, which honestly makes Doug and I's job a lot easier to accomplish. But because of that, it makes it easier for us to put together a portfolio. And it's very important that you understand, again, I know I keep repeating myself, but it's important to understand how your portfolio is constructed. Now, before we turn it over to Beth for some questions, for the folks that are on the line that are clients and for our guests, I just want to give you a little bit of a scenario and kind of a recap of what we did concerning some of our clients. Now, again, we didn't do the same thing for everyone. We pride ourselves in that because we don't believe in the cookie cutter approach. For those of you who are clients who we didn't do some of these things for, you'll have a good understanding of why we didn't. Every one of our clients is a different age, a different risk tolerance. They have different goals, different objectives. So we build each portfolio basically for that individual situation, rather than saying, hey, you're 62 years old, you're going to retire in 3 more years, this is what you should have. That's incorrect. That's not what an advisor should be doing. So post-election, no matter who wins, we feel very positive about 2021. And there's basically 4 reasons for this. We know there will be stimulus. We know whoever wins is going to get a stimulus bill passed. Now, a big headwind to that will be is if they drag this thing out till February, the carnage that could happen for these small businesses between now and February, we really can't put a number on. I hope and pray that they get this done before then. A lot of these companies need the money. Also, there's going to be a possible vaccine in 2021. It's going to happen at some point. And when it does, the leisure sector, meaning airlines, cruise lines, restaurants, they're really going to take off. People eventually will start going back out. Hopefully the vaccine is able to get administered quickly to the people who need it, the high-risk individuals, senior citizens, people in nursing homes, things along those lines. But at some point, there will be a vaccine and the country will start to open back up. Third, and probably, unfortunately, whether you agree with it or not, it's the biggest reason we're seeing the type of economy we're seeing and what we think about 2021 is the Federal Reserve is going to continue to print money. They really are. I don't necessarily agree with it. I think the stimulus was needed. This is kind of a topic for another discussion at another time, but they will backstop this stock market and they will backstop it heading into 2021. The biggest concern we had a few years ago was the rise in interest rates. Everybody was concerned about make sure you don't get in long-term bonds because interest rates are going to go up. The Fed has basically tabled that till 2024. Now, one headwind, if inflation pops up, they might revisit that idea. but for the short term, they're going to definitely backstop the stock market. Also, the cash sitting on the sidelines, not just from the retail investor, but from hedge funds, money managers. The total cash on the sidelines right now is $4.3 trillion. I mean, try and I can't even conceive that much money. But what that means is that is money that is sitting on the sidelines that's waiting to be invested. This number was almost 5 trillion in April. So to put it into perspective, a large sum of that has already been invested. The average for sitting on the sidelines is around 2 trillion, so we're double that. So there's a lot of money that's just sitting there. And why is it sitting there? People are scared. They don't know what to believe. Unfortunately, with a retail investor, which is what all of us are, that's why we hire money managers, the retail investor is usually wrong. Once you see that retail investor starting to invest money and feeling comfortable about the stock market, that's the time to jump out. That's a Warren Buffett strategy. He buys on fear and sells on upswings. The other thing that we want to make you clear on is that because of these 4 things that I just talked about, we are bullish moving into 2021. So for what did we do for our clients through this pandemic? Right now, we raised a lot of cash in the months of March and April, which is sort of timing the market, which is everything that we're against. But unfortunately, this was a situation where we had never seen this before. And it took drastic measures to offset drastic situation in the economy. So we did raise money. But when we raised that money, we did it in an unconventional way. We took it from the safer investments. We didn't take it from the investments that were all stocks or very highly allocated towards equities. We took it from your safer investments with the idea that when we start to get a rebound, we're going to put this back and make you just a little bit more aggressive in the short term. So that's essentially what we're doing right now. We started dollar cost averaging the money that we raised in March and April. We started dollar cost averaging that back into our clients' portfolios in September, in October, and we have 2 more tranches for most folks to go in November and December. Our thought process behind that was we will get 2 investments in before the election and 2 after the election. So we don't know which way the stock market's going to think and what it's going to think of the election. So this way we would make sure we were all covered. For some folks that were not able to invest in a Coho Partners or a Schaefer Cullen because they didn't have enough assets to allocate to that, those are large cap value managers. We purchased an individual ETF so that they could get some all stock exposure to the large cap value space, which we still feel very, very highly about, and we think is going to do well because there's going to be a cycle and a shift heading into 2021. We also recently have purchased gold inside of some of our clients' portfolios. But with any of these purchases, I want to make sure everybody hears me loud and clear. We have dollar cost to average that money in. We're not ones to just take money and dump it in and hope it's a great day. If somebody comes to us and wants to invest $50, $100, $200,000 in the climate that we're in, we're putting that in over 3 to 4 months. We think it's the safe thing to do. Sometimes it's worked out and sometimes it hasn't. But let's face it, with a lot of our clients, we'd rather err on the side of caution than to try and hit that real big bang. Also, for those of you who have SEI's ETF moderate portfolio, SEI has been adding gold to their portfolio and decreasing US Treasuries, which are paying basically nothing at this point. So we are seeing a little bit of a shift there. We're using gold as a hedge. We're not buying gold anticipating the Armageddon coming or anything. We're just using it as another way to hedge against inflation because the bonds and interest rates and yields are just so awful right now. We feel large cap value is a better way to be positioned heading into 2021 versus growth. Growth is what's driven this bull market over the last 8 or 10 years. A lot of the growth has come over the pandemic. A lot of the large cap growth is technology, your Microsofts, your Amazons, your Apples, your Googles, your Facebooks. Those are what driven this entire stock market. Now we feel that they'll still do well moving forward, but as they start to declare what they feel their earnings are going to be, we saw Microsoft have great report, but gave difficult guidance moving forward. Mainly because you can't beat what the second quarter did for these companies. There's no way they can repeat it. So obviously it's going to go down, but the market is sometimes so short-sighted that that's what they see. So the stock actually suffered a little bit last week. Now, we feel strongly that Microsoft's going to be around for a while and do well. But with the two large cap value managers that we use, Schaefer Cullen, they are focused on very large mega cap companies, have solid balance sheets, and pay a good dividend. We love companies that pay dividends. We try to overweight our clients currently to them. The dividend to large cap value market has severely underperformed to large cap growth. So we're doing the unconventional thing, and we're dollar cost averaging money into that because we know these mega cap companies are going to be around for a long time. The other large cap value manager that we use is Coho Partners, and Coho Partners is they are focused in the healthcare and consumer staples area. So this is just a couple ideas that we have used for our clients. Most of you have 3 to 7 different strategies out there, and you have those strategies because we want to be diverse. We want to be flexible. We want to be able to move with whatever happens in the economy. So with that being said, I know I took up a little more time than I should have, but I just want to turn it back over to Beth, and we can answer any questions that people might have.
Thanks, Mike. I know we have gone over time and we have shared a lot of great information. So thank you, Doug, and thank you, Mike, for sharing this halftime report with us. If there are any questions that anyone has, feel free to type them in to the question pane. And what we will do is we will send a follow-up email directly from Mike and Doug and team answering any questions that you may have on what you heard today. And as I shared at the top of our presentation, we'll also be sending a recording of this session. So you will have all of this information and can listen to it again. And then if you have any questions, you'll also have contact information for both Doug and Mike and the team at Key Advisors. With that, if there are any questions, feel free to type them in the pane now. We'll give everyone a second to do that, and then we will get ready to conclude our presentation. Mike and Doug, it looks like we have a few people who are just asking to be contacted after, so I will make sure that that information gets passed along. Looks like it's for questions about how to begin being advised. So I will pass that along to you.
Very good. We'd be glad to help those folks out for sure.
Great. Well, again, thank you everyone so much for your time today. We at Nobles Pond in Dover appreciate it. And again, thank you to Doug and Mike from Key Advisors, one of our trusted partners who have worked with several of our homeowners and are available should you have questions regarding financial advisors.
Thank you, Beth.
Thank you, Beth.
Thank you all. Have a great day. Take care, everyone. Thank you.
Bye.